Japan issues final warning as yen breaches 160. The Japanese yen just crossed a major threshold, breaching the closely watched 160 per dollar level on Wednesday. It hit 160.73, marking its weakest point since July 2024. This drop triggered an immediate and sharp verbal response from Tokyo's top officials, resulting in a rapid reversal that shows just how high the stakes have become in the battle between market speculators and Japanese authorities.
Verbal barrage sparks reversal. According to reporting from Market Pulse and Futun News, Finance Minister Satsuki Katayama issued her most forceful warning to date, stating that the timing for bold action is approaching and pledging to monitor the markets around the clock through the Golden Week holidays. This was quickly followed by a final advisory from Vice Finance Minister Atsushi Mimura, who told speculators they should escape while they still can. These warnings worked, causing the dollar-yen pair to tumble 0.9% from its intraday high, which was the sharpest daily reversal we've seen since mid-March.
The yen's slide gained momentum after the Federal Reserve held interest rates steady this week. As reported by CNBC and Bloomberg, the Fed voted 8-4 to keep rates in the 3.5 to 3.75% range. This is expected to be Jerome Powell's final meeting as chair before his term ends in May. Between this hawkish stance from the Fed and oil prices nearing $100 a barrel due to Middle East tensions, a factor highlighted by Reuters, the interest rate gap between the U.S. and Japan continues to put heavy pressure on the yen.
Short positions test Japan's resolve.
Investors are betting heavily against the yen, with Reuters reporting the largest short positions in nearly 2 years. Data from the Commodity Futures Trading Commission shows that these bearish bets have been climbing since February, reaching their highest levels since Japan's last market intervention in mid-2024. The selling pressure is widespread. The yen has hit record lows against the Swiss franc, its weakest level against the euro since the single currency was first created, and its lowest point against the British pound since the global financial crisis.
Even Japan's retail traders, famously known as Mrs. Watanabe, are getting in on the action. According to HSBC data cited by Reuters, these traders hold their largest short yen positions against other major currencies since early 2020. This comes as the Bank of Japan decided to leave interest rates unchanged at 0.75% on Tuesday. While Governor Kazuo Ueda has signaled he is ready to raise rates to fight inflation, the decision to hold steady for now has done little to relieve the pressure on the currency.
Intervention threshold in focus. Experts are divided on exactly when Japan will step into the market. According to Futun News, Goldman Sachs strategist Karen Reichgott-Fishman suggests that if the dollar rises rapidly toward 163 or 164, the chance of direct intervention will jump, even though she believes the yen's current weakness aligns with market fundamentals. Meanwhile, J.P. Morgan strategist Ikue Saito believes the trigger point is lower, stating that intervention is very likely before the rate even reaches 162.
Looking back at previous efforts, Futun News and Reuters note that Japan spent over 9 trillion yen, roughly $60 billion, to intervene multiple times back in 2024 when the currency last broke 160. However, analysts point out that those efforts only provided temporary relief. With interest rates still so far apart, the fundamental economic backdrop is difficult to change. As former Ministry of Finance official Junya Tanase told J.P. Morgan, in this situation, there is no rule and no manual for how to proceed.